Lionsgate, the iconic entertainment company behind blockbuster franchises such as The Hunger Games, Twilight, and John Wick, recently announced that it would separate from its studio business through a merger with a blank check company in a deal that values the division at $4.6 billion. Lionsgate's stock has jumped by roughly 25% since the announcement, so join us as we explore the deal, why it happened, what's next for Lionsgate, and the possibility of the company's peers following suit. Welcome back to PST Markets. Let's talk about the blank check company Lionsgate is merging its studio business with. The company is called Screaming Eagle Acquisition Corporation, a special-purpose acquisition company set up by veteran Hollywood executives Harry Sloan and Jeff Sagansky. Both Sloan and Sagansky have impressive resumes, as Sloan used to be a chairman of both Metro-Goldwyn-Mayer and SBS Broadcasting. At the same time, Sagansky was a former president of CBS and a former co-president of Sony Pictures Entertainment. Together, they have launched more than 7 special-purpose acquisition companies, or SPACs, since 2011. In fact, Sloan and Sagansky completed one of the most successful blank check company deals ever when they helped take public the U.S. sports betting group DraftKings, which now trades at 5 times its initial valuation. However, not all of them were successful. They attempted a deal to list the Bill Gates-backed Ginkgo Bioworks at a $15 billion valuation, but the company is now worth a fraction of that. Notably, the plan to separate Lionsgate from its studio division comes 2 years after Sloan joined Lionsgate's board of directors. The newly created Lionsgate Studios will include the television studio and motion picture divisions of the Lionsgate Group, which is behind successful franchises such as John Wick and the Oscar-winning film La La Land. In addition to that, it will include the company's talent management and its production and distribution businesses. As part of the transaction, Lionsgate Studios will receive a total of $350 million in exchange for 12.7% of the studio business, which is valued at a total of $3 billion. Half of the money will come from the cash held in the SPAC trust, and the rest will come from a private investment. As for Lionsgate's cable and satellite television network, Starz, it will remain under its ownership. In addition to paying down debt, Lionsgate will use the money to fund an acquisition deal of its own. In August, the company agreed to buy film and TV studio Entertainment One from Hasbro for around $500 million. Lionsgate will continue to hold 87.3% of the total shares in the newly formed company, with Screaming Eagle owning the rest. This prevents the new company from being deconsolidated from the parent company, and as a result, the studio business financial results will be consolidated within the financial results of Lionsgate. However, the company maintained the right to pursue a full spin-off in the future. Lionsgate CEO John Feldheimer and Vice Chairman Michael Burns said this transaction would create one of the world's largest publicly traded pure-play content platforms. The deal is expected to close in the spring of 2024, after which Lionsgate Studios will begin trading independently. It is likely that there will be a distribution of shares of the new studio stock to Lionsgate shareholders at some point. Finally, the deal is subject to some closing conditions, including regulatory approvals and approval from Screaming Eagle's shareholders and public warrant holders. One of the reasons this deal is interesting is that it's unusual for a SPAC since it involves taking out a division from an already public company. In contrast, SPACs usually involve raising money on the stock market and finding a private business to take public. But another thing that makes the deal unusual is why it happened, and the answer to this question is Lionsgate's desire to separate its studio business from its cable and satellite television network, Starz. This has been a persisting issue with Lionsgate for 2 years, and the company actually detailed its plans to separate Starz from its studio business in July of this year in a Form 10 filing with the SEC. Additionally, Lionsgate CEO John Feldheimer said that the company wants to separate Lionsgate and Starz to become standalone companies with strong financial foundations, allowing each company to pursue its own distinct strategy. So, why does Lionsgate want to separate from Starz? Originally, Lionsgate wanted to offload Starz because it thought the cable TV business was weighing down its business and stock price. That separation would allow investors to receive a better value from both. This is because Lionsgate bought Starz in 2016 for $4.4 billion, but has since seen the company's value drop as people abandoned cable TV and started to switch to streaming services such as Netflix, Amazon Prime Video, and Hulu. After 2 years of planning, it seems the two divisions are finally separating. Lionsgate possibly took a long time to finalize the separation process, partly because of its involvement in the acquisition of Hasbro. The best time for Lionsgate to announce the SPAC deal is now, since the company's current financial conditions are pretty good. Thanks to the recent release of The Hunger Games, The Ballad of Songbirds and Snakes, Lionsgate had a strong presence at the box office. The movie made a worldwide total of $315.3 million, and its stock has been up roughly 17% since its release. It's no surprise that Lionsgate's management believes that a standalone studio business can be much more valuable considering the success of its movie franchises. In other words, separating the studio's business from the rest will result in a valuation more reflective of the studio's business outlook than Lionsgate's current valuation. This is made even more clear when you look at the estimated values of Lionsgate's biggest franchises. According to Rosenblatt securities analyst Barton Crockett, Lionsgate as a company is worth around $4.8 billion, but its library, which includes The Hunger Games, John Wick, and Twilight, alone has a net value of $5.525 billion. So will this become a trend for other entertainment companies to adopt? There are as many arguments for the importance of deconsolidation in the future of the media and entertainment industries as arguments for consolidation. While most of the media giants like Fox, Disney, and Paramount are attempting to consolidate the media empire, streaming giant Netflix chairman Reed Hastings went as far as saying last year that he believes more consolidation in the media sector is on the way. Lionsgate is going down the deconsolidation path and believes that media companies are better off becoming pure-play content platforms. They even had a slide in the investor presentation highlighting the advantages their path as compared to the one other legacy media companies are on. Legacy media companies compete for the top spots on the list of global streaming services that offer unique content distributed over 175 to 300 million households worldwide. This path requires consolidation so that media companies can have a budget big enough to compete with Netflix when it comes to marketing and the breadth of available content. This makes them more bound to vertically integrated captive platforms and a large self-distribution structure. Lionsgate believes this is risky. The worry is that these media companies and their platforms are small, and the need to reach a larger audience and expand the provided content will be costly and make churn a real concern. Despite that, consolidation remains trendy, which is clear from the recent mergers of Fox and Disney, CBS, and Viacom, Discovery, and Warner Brothers. On the other hand, the deconsolidation path Lionsgate is going down is claimed by the company to offer many advantages. They include having the option to license at competitive rates and focusing on international licensing to reduce risks. This is essentially because Lionsgate is planning on becoming a distribution-agnostic company focused on selling content to the highest bidder, without worrying about marketing and self-distribution costs or the number of subscribers. Additionally, Lionsgate believes that deconsolidation creates more value for shareholders since it provides an opportunity to reduce leverage significantly while, at the same time, showing the value of Lionsgate's studio business at a valuation more reflective of the studio business outlook than what Lionsgate's current consolidated valuation reflects. Will we be seeing Disney or Warner Brothers attempt deconsolidation in the future? This likely depends on how Lionsgate Studios stock performs compared to stocks like Disney stock or WBD stock. If Lionsgate Studios stock outperforms, then more media companies would probably be willing to separate studios and streaming as well. If it underperforms, Lionsgate can still fully sell its studio business to a larger company, which would certainly give the company a lot of money since its 87.3% represents around $2.677 billion. That is everything for now. What do you think? Is deconsolidation a better strategy for media and entertainment companies? Please let us know in the comments below. If you haven't, please subscribe and like this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.